are in listen-only mode.
Good afternoon. I'm Roy Weiler, Director of Trading Operations for Time Leverage Capital. For anyone who's missed our previous webinars, please give us a call at 800-519-9085 and we can send the videos you missed. Or you can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now, for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we will do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software. He also served as chief strategist of Dow Jones Megatrends and All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage, Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Buying Put Options, a Bearish Outlook Rising Volatility Strategy webinar. Mr. Mueller?
Thank you, Roy, and a happy Tuesday afternoon to everybody. Let's take a quick minute to review. We are currently on the second item in our basic options module, and we today are going to be covering very specifically using our basic option calculator and basic futures calculator. The same will apply to the basic stock calculator on transactions for buying puts. Please remember that if you have any questions, there's a pretty extensive features and FAQ section that you can find on the web page. Be sure to go to it. And of course, if you have you can either ask us a question at our customer service line or you can submit a question online. We also have a very extensive and growing video library of examples, explanations, definitions, illustrations, how to input trades, the basics of different concepts such as classes of options, in at, out of the money options, combining futures and options, likewise on stocks and stock options. So please be sure to look for those. You can locate the demo videos and definition sheets in the reference material section, and you can see the FAQ section in the FAQ and guide section. Now let's proceed directly to the next trade, to the scenario which we are contemplating. Again, in putting together a trade, an investor should have some sort of a system or plan in place, and what we are following is a very well-established and traditional approach for defining trades. The first is very well known. It is a question of defining a direction on a trade. And in today's scenario, we will be looking to illustrate some trades that have a bearish outlook. A lot of people are not quite sure how to trade a down market. Today, we're going to have an introduction to one of the strategies for trading a directionally bearish market, but we add the second very important ingredient in selecting a strategy, and that particular ingredient is what is the volatility outlook. So we usually want to have at least these two criteria in place in order to come up with a better informed and more targeted strategy to match the outlook. So when we are looking for a downwards direction or a bearish direction with rising volatility, and we have programming and definitions of volatility as well that you can follow, we have essentially two trades that pop up in our strategy gallery. We have the long put and we have a put ratio back spread. Although both belong in the bearish direction rising volatility area, they are actually different trades, and it is a nuanced decision which one you want to use. Today, for purposes of this basic program on the pillars of option trading, we are going to be working with an illustration of being long a put or purchasing a put. And for that particular scenario, let's pull up a graphic, and this graphic is very commonly used and has a long history of being provided by exchanges and other brokers. Let's go ahead and see how this looks, and I believe you'll find our spreadsheet to be much more user-friendly and helpful in actually digesting the targets and price levels. As you can see, a long put is a directional trade. We use it, or a person uses it when that person believes that the market will fall greatly or with rising volatility, not looking for a small drop, not looking for a slow drop, looking for a strong drop with rising volatility. Okay, the more bearish the person is, the deeper out of the money they can buy options. Of course, far out of the money options have a lot of limitations, which we can go over at another time when you look at classes of options. The less bearish you are, you buy options in or at the money. One of the reasons buying puts is a comfortable way for certain people to short the market is because it has an unlimited profit potential. The profits increase as the market goes down in volatility, with rising volatility, but the loss potential is limited. So whereas one shorts a futures or a stock, there is a margin risk. In buying a put, the risk of loss is limited, and the person can't lose more than they paid for the transaction, which is the premium and commissions of the trade. So although this sounds appealing, it's an unlimited profit potential with a predetermined and limited risk that can be measured as the total cost of the trade. Time decay is an adversary of this trade. As time passes, that portion of value in the option erodes, and it is a wasting asset. So a person has to be mindful of time erosion and monitor premiums and values closely. In this particular example, as you see in purchasing a put, the person purchased a put with a strike price of 86 for 2 premium points. Therefore, in order to become profitable over this particular time frame, that premium of 2 points that has been paid has to be overcome before the trade becomes profitable. And as you can see on the grid, intrinsically the trade has to go under 84 points, under 84 units, to overcome those 2 points of premium that were paid, and then to overcome and go into profits. Now that we've seen the scenario that we need a drop with rising volatility, we're going to go ahead and follow some examples, and our primary examples that we've set up today, because primarily a lot of people have a great deal of interest, we've used our basic option calculator, and we've already set up some of these trades for ease of viewing. If you want to input your own trades or set up your own tabs, you can do that using our demos, our username and password, or somebody on our team, somebody in our development group or service group that will take you through the trade. Now again, when somebody inputs this trade, as we did, several things happen. Number one, for learning purposes, for reminder purposes, just so nobody forgets or makes a mistake at the last minute, the trade is redefined as a trade which looks for a downward direction and rising volatility, and there's a very effective graphic of the effects of time decay on this position. Anybody who's ever bought a call or bought a put or has paid premium for option knows that if time decay can overcome even a move that goes according to our direction, if it is not enough to compensate for the passage of time and for distance from the strike price. So once we input the trade, in this case it was the S&P 500 index, when a trade is input, you immediately get a dialog box that gives you the contract specifications and also gives you the strike price example, an example of what is a strike price on this particular market and how to input the strike price. In this case, it's the price at which you have the right but not the obligation to be able to sell this market, because you do want it to go below 1850 and buy it back lower. Premium points, again, are input in a dialog box, and we do have additional links for assistance, further defining terms such as strike price, premium, and the different classes of option. And then when the calculate button is hit, we get a spreadsheet on this trade. What is the trade? The trade was purchasing one 1850 put. And in what market is this? Just a minute. We are looking at the, just a moment. In this particular case, let me make sure I'm pulling out the right trade. We're going to be looking at 3 trades, 2 in the mini S&P and 1 in the large S&P for purchasing puts. And as you can see, we can scroll back and forth between those trades simply by clicking those trades and complying them at a moment's notice. If we go from the large contract to the small contract, as we just did, the tick values change and the explanations and the calculations change accordingly. So let's have a look at what this trade can accomplish and what's really important, which is the bottom line. Purchasing this one E-mini 1850 put, and this put is a March. You'll see how we saved it under the tab. It's buying a put in March. The direction is down, the volatility's up, and it's a non-margin trade. You also see the date that the trade was input. We input it today, and then we can save this trade and keep monitoring it or changing prices according to updates in the market. This particular person paid 9.5 points in premium for the trade, which translates into dollars, $475 based on the tick value. We factored in a default commission in this particular case of $45 around turn. Be sure to include all your costs in your under your transaction costs so that you get a complete picture of where you are. Based on those defaults, the person will pay a net debit, including costs, of $520. $520, and that, as you can see here, and as we've already found out on the long put graphic, is the maximum risk that can be lost, which is the amount that was paid for the option, in this case, the $520, which is inclusive of commissions and fees. When we translate this into premium points, in order to, we add in the commission to the 9.5 premium points, so that makes it 10.4. So throughout this trade, if you want to offset this put, and you want to know if you're making money or losing money based on where the market is on any given day, this is the price that you monitor, the premium break-even point. And you do not need to hold this position to expiration. If there's a major move in any direction, you can check out the values on that option. If it's trading, how much it's trading for, and determine whether you want to or are able to make an offset.
We have a question.
Go ahead.
Is it ever appropriate to buy 2 puts further out of the money as opposed to one closer to the money if the cash outlay is the same and the combined delta is as well?
Well, the only obvious variable in doing that transaction is that you have 2 transaction costs instead of 1, so there will be a fractional premium change. Also, buying farther out of the money, and although there's a presumption of delta being the same, the far out of the money options do require a greater move to become intrinsic. So if the volatility does not go up, and on a smaller move, again, you would have to really feel confident that the move is going to be a greater move with rising volatility. When you talk about transaction costs versus the leverage, it's certainly a consideration, but you should think very strongly about that. One of the great things you can do on the calculator is you can do that math very quickly. So let's go through this example, and immediately thereafter we'll do something that anybody can do who has their own tab. You see a trade here that in theory costs $500. We got the break-evens, we got the tick value. It's a pretty significant amount of leverage. Remember, it's 50 times 1865. So we're talking about a contract that's above the above $90,000 in value. So there's plenty of value. And as you can see here, if you look at, you have the premium break-even, and then you have your futures break-even. In this particular case at expiration, the futures break-even point is 1839.60, meaning that at expiration or intrinsically the market has to be below 1839.60. It's presently at 1865.5. These are March options, so they're quick eroding. Now, if you look at the risk-reward potential, again, the risk is very limited. It's a short-term trade. It's a premium trade, and you can find your break-even somewhere slightly under 1840, and then you see the profit scenario intrinsically and on premium as the market goes down. You can easily take this transaction and say, well, let me see, maybe I don't want to have this particular trade. Let me change this trade. Let me go ahead and buy 2 options farther out of the money. So can we get a price on the 1830 puts, shall we say, for March?
They're trading at about 5.5.
Okay, so let's change that to 1830. Let's change that number to 5.5. Then we calculate, and actually we can save it under the same tab, which is the buying E-mini puts. So let's save that under the tab. This is under E-mini, buying the March puts. We have all the particulars there, and we can save the trade, and now we can have a quick look at it. Now everything is updated. As you can see, the strike prices, the outlay, excuse me, you see I made a mistake. I just left 1. I didn't change it to 2 units. The software picks it up right away. So I don't need to re-input everything or reset everything. I just changed that to 2. I can do that calculation. I can also save it under the same tab. So once the tabs are set up, it's very easy to save trades and compare trades, and we can help with the tab setup while people get accustomed to inputting their own trades. But now under one tab of buying E-mini March puts, we've got 3 trades to compare. We've got buying the 1850 at 9.5. We got buying an 1830 at 9.5. Now you see the cost is significantly lower. The risk is less because the maximum loss is what a person spends, and this person spent less. However, their premium break-even is also lower. It's a 6.4. But wait a minute. The market has to get to 1823.60 versus the 1836.90. And this is one of the fun things that we do with the software, the way things are aligned, is you can actually look at the maximum loss here, have a look at the break-even, then click back to the previous trade, and you're going to see the next round of calculations. Let me just actually click on the previous trade. Okay, and the selected trade gets loaded, and now you see the other number. So you see the break-even here is closer to the market. It's 1839.60 instead of 1823.60. So for a person who would purchase one of these would really intrinsically be looking for a larger move or a larger volatility move. If we go back to the 2-lot and compare them, okay, and as you can see here, we have them side by side. Now the outlay is fractionally more than the last one. It's 550. So it is a 2-lot. It's 20 points farther away. The break-even now is actually 1823.60. So you see the slight impact there of the fees. The maximum loss is 640. But when you look at the profit and loss scenario on the trade, on a very big move, on a significantly large move, although on a small move it takes it's more difficult to get intrinsic on and hopefully profitable. On a large move, because you have 2 positions, once they start gaining for tick, they outperform the other. So again, in this particular, to answer that question and to show the feature, it is a question of where one thinks the market will go and with how much rising volatility. In this case, one would have to look at a chart and see whether these numbers in the time frame provided are more realistic. If you're looking for a big volatile, explosive drop, then yes, the out-of-the-money plays in those exceptional cases will actually provide greater results, as will anything that is perceived to be a greater long shot. Now I want to go ahead and move on, and again, we've been doing illustrations on the E-mini contract, which is 50 times the index. I want to show, and this is very important for purposes of time comparison, the same strike price in June. And as you can see here, instead of paying the smaller amount of points, 9.5 and 5.5 points that we were paying previously, when we are looking at the E-mini in June at the same strike price at 18.50, because of time value, the premium is much higher. And you see everything again, updates here. You can go to the contract specs, you can go to the contracts, and let's look at the particulars of buying this E-mini contract with that much time farther out. You can see there's the premium is higher. We're paying $2,500 instead of somewhere under $550. You're factoring in your costs. So now, as we can see, the break-even on futures, there's more time, but the break-even now it's 1799.1, and the premium break-even is at 50.9. And this is the price that one keeps monitoring throughout the transaction. The maximum loss, again, is predetermined and limited to the total cost for purchasing the option, which includes the premium fees, and is calculated here. We have a reminder of the math in this little box, contract specs. It's $50 a unit, and now we can see, however, that given more time, our break-even is under 1,800, but then, of course, on a significant drop, let's say, for instance, if somebody thinks that the market has a chance of dropping to 1,740 or lower, the greater the volatility, the bigger the drop, the more a trade like this benefits. On the other hand, since this is a more expensive amount of premium paid, and it's a more significant time into June, the person who purchases this option should be mindful that if the trade does not drop with rising volatility as expected, it will be wise to monitor this premium and to mitigate or minimize losses as much as possible by having some sort of an exit strategy. And whether that strategy is an alert or a time frame, I think that it's, except under the most absurd or difficult circumstances, a person who spends $2,500 in premium should be able to offset at some point before expiration without incurring the maximum possible loss, which is the entire cost of the trade. I would probably have a very close look at this trade if it was down somewhere between $700 and $1,000 and reevaluate whether the direction and volatility outlook in putting this trade on merits a review and an amount of reconsideration. So now finally let's go to an example again, because there are different contract sizes. So this position might be appropriate for somebody who is perhaps protecting a $95,000 portfolio against a certain amount of drop over a given time frame, or just speculating on a drop with rising volatility. But there are multiple contracts and multiple contract sizes, which is one of the reasons why we input all these values in the option ranger so people can pick the right instrument. So in this particular case, we went with the S&P 500 index. This is not the E-mini contract. It is the larger contract, and immediately we have the contract specs right here. It's 250 times the index. So now we're talking about 1866 times 250. You're talking about a significantly larger contract, 5 times the size of the current contract, of the mini contract, above $450,000 in value.
We have a request for looking for a dropping market on rising volatility scenario of either in the crude or the gold market.
Okay, very good. Let's go ahead to that. Again, I just want to show on this larger contract, the values change significantly. The leverage bigger, the maximum loss is 12,545 in the box. But somebody, let's say, has a $500,000 portfolio or more, and wants to protect or wants to somehow hedge against a significant drop with rising volatility past a certain point, as you can see on a very significant drop, one of these puts can start to mitigate some of those losses. Of course, if the market stays firm or it doesn't drop sufficiently, that entire premium is at risk. Let me go ahead straight now to reset this, and we had a request for a gold market. I just want to point something out to everybody. There are two contracts. There's a regular contract and there's a mini gold contract. So when you look at these instruments, it's always wise to see the one that has the appropriate leverage and the appropriate liquidity for your budgets and for your trading style. In this case, we're going to use the standard 100-ounce gold contract. All the contract specs are here, and this will take you to a page that will give you the contract specs and all of the what to watch and what needs to be monitored in these markets. For a strike price in the gold, and we're going to go ahead and look at the month of June, which is at 1347.60 right now. So we're going to let's go ahead and buy a 13. We're looking for a drop. Let's buy slightly out of the money. Let's see what we can get at 1320 basis June. And again, you see how the inputs are. When we input a strike price, the example comes up, and then when we click on the premium box, an example of premium comes up, along with a link to more helpful information about how to input premium and the definitions and variables that determine premium. So what do you have as a premium for the June 1320 put? The market's at 1347.
It's going for about $26.
Okay. So we see how to input there in the box. So let's go ahead and put in 26. Okay, so let's input a default costs, and let's add some rows so we can get a big picture, and hit calculate. Now again, in this particular case, we have a contract that, as we've seen, it's $100 an ounce. So 26 times 100 is 2,600. That's 100 ounces times 26. The costs are factored in both into a dollar figure and into a premium figure. So we have to overcome a premium of 26.45, and this particular position either has to be worth more than 26.45 in premium, or intrinsically has to drop under 1293.55. Again, the parameters are the same. The maximum loss on the trade is limited to the amount to the total amount spent, which is the premium plus costs, plus transaction costs. We have a review of the contract size and tick values, and let's see what this anticipation would be. If we get below our break even here of 1293.55, as you can see, the straight trade starts making money on the way down. It's $10 a tick, so if somebody's anticipating that this market can get below these levels with rising volatility, this would be a scenario to review. There are different months and different strike prices that can be input once this tab has been created, and you just saw how easy it is to create a tab so that you can play around with the strike prices, you can play around with the premium points, you can play with the expirations and so on. In this particular case, it seems that the premiums have gotten a bit steep, and if the market doesn't drop quickly, again, I would be mindful of watching the position and monitoring for losses. And again, we have this trade, the minute it's input, even if we don't save it under a tab, it's saved under here, so we can look at it later or save it under a tab. And now we're going to go ahead and reset and do a crude trade. I believe you asked for an example on crude oil?
Yes.
Okay, so we'll just hit the reset box, easy as pie. And when we select the contract market, we can either scroll down or we can just start typing the name of the market, and sure enough, it comes up. And as you can see here, there's a crude and there's a mini crude. You can trade a mini crude in futures. And again, you have to find the instrument that is right for you. Now we're going to work with the 1,000-barrel contract at $10 per tick. You can always go to more information, trading hours, what to monitor. The trading strategy, as before, is buying a put. The minute we click on buying a put, the dialog box comes up. to remind us what the scenario is that we need, and so we can do a little bit of an opinion check on whether that's not what we expect on the strike price. And we're going to be looking at June crude oil, which is currently trading at 98.56. So let's say for the June crude oil, let's go ahead and pick the next strike down, which would be at 98. And this would be on the month of June. So we see here how the premium gets input. It's dollars, so it's that times 1,000 barrels in our contract specs. So what is the premium for that 98 put in June?
$2.90. $2.90.
Okay, $2.90. We're going to know that's times 1,000. It's an easy tick to select, but we want to go ahead and look at a fair number of rows, and let's hit the calculate button. Everything populates easy as pie. One contract, 2.9 times, remember it's 1,000 barrels is 2,900. I don't know, I input a fee of 70, but we'll just leave it alone. That's a little steep. Actually, I wanted to have 70 in the rows. And 55 in the fees, so we're just going to hit calculate again and everything gets fixed. And now we see the trade is 2,900 plus cost. The maximum risk is the cost, the initial cost of the trade. Again, you need to monitor that risk and get out early, either with profits or with losses, not play it out to the last minute. You're looking for dropping volatility. And let's see this trade here. As you can see, if crude oil flies to the moon, if something happens in Iran, doesn't matter. The most that can be lost is the premium and the cost of the trade. On the other hand, on a drop under 94, under 92, certainly getting into the 80s, this position can become, on rising volatility drop, looks like a mover. If you look at a long-term chart, I think it's easier to see perhaps the crude market somewhere in the past hovering at or below these levels. So again, one would have to find out what's their outlook, what's their geopolitical outlook, what's the technical outlook. And somebody thinks that there's a chance of rising volatility on a drop. As you can see, some of the numbers, certainly as you get down into the 80s and below, on this kind of a trade, get pretty interesting. If an outright put does not work, that's when you come in. You go back into our strategy gallery, and you can say, well, I don't think it's going to drop with that much volatility rising, but I'm bearish. That's when you start exploring some of the other strategies. But again, based on today's example, for a drop on crude with a rising volatility, as you can see here, we have one example of a trade, which is the June strike down at 98, has this predetermined risk and a fairly strong potential on a big drop, but it will require a drop, as you can see, with rising volatility in order for that trade to become profitable. Otherwise, time erosion or the wrong direction could do a real number on the trade. Any other questions?
We do have one last question. This is actually going back to the gold example. Once when I had a good profit in a gold put, my broker wanted me to sell a lower strike put against it because I would collect enough premium to cover all my costs. Why not just sell the one I have and purchase the cheaper one to replace it?
Well, I think in effect both scenarios contemplate collecting some money against the existing position. And both examples contemplate selling a put one way or another. The one example, and again, it depends on your volatility outlook and direction. If you're not sure how to answer that question, there could be a basic difference. One difference could be that the person who sells a call, who owns a put and then sells another put to leg into a bear spread, or in this particular scenario, it might mean that they expect the direction perhaps to continue to the downside, but the volatility to diminish. So that is one very different outlook. On the other hand, as a question of volatilities. If one option is very deep in the money and it's performing tick for tick, but somebody is expecting the volatility to continue to rise, then there are a number of things that can be done. I think selling one option and buying another that have essentially the same outlook would require some explanation of money management or some changing of volatility outlook. Otherwise, I think that one must be careful not to replace trades that are similar or identical unless there's a very good reason. So I think that if I sell a call and I buy a call the same day, I have to make sure that I'm not basically going in two opposite directions at the same time for no reason. So I think that if the scenario is, hey, there's huge volatility, I think this market has run its course, it's dropped with rising volatility, but now it's going to go down, you might as well sell a put. If you think volatility is going to go up, then probably you might as well just buy another put, or, you know, it's really only in fear of losing current gains and for money management purposes that one would offset one call and sell another for less money just to have less on the table. But again, if that new option is out of the money and is relying on even further volatility, under certain circumstances, one may be swapping a good in the money position for more of a long shot. So I'd have to see the particulars of the trade. There are scenarios under which both could be done. Again, depending on the change in volatility outlook or in directional expectation that precipitates this change from keeping a position that is gaining, a long put that is in the money, presumably, and gaining, with a put that is either less in the money or out of the money. That would contemplate a change of outlook. And again, if the change of outlook is consistent with that, then it fits in our strategy gallery, then it would make sense. But again, to the extent that there's a cost factor there, I would always err on the side of conservatism and try to leg into a free or a cheaper trade unless I had a volatility outlook of continuing rising volatility. Any other questions?
No, not at this time.
Okay, I'm sorry if that's more of a discussion that we'll have during our usual spread sessions on Wednesdays or on Hot Market Fridays. And adjustment strategies and follow-up strategies is one of the key things that we have had requested from our beta group. You know, it's one thing to pick a trade, to get into a trade, to break it down and analyze it to the umpteenth level. But then once somebody is in, we don't always have the luxury of taking that kind of time to make choices in the market, and that's where we want to have a system to follow up and monitor different positions for the appropriate adjustments. And as much of the trades is about getting out or how to deal inside of a trade as it is to make a decision of how to initiate a trade. So I think the question is good, and it's something that by request is becoming more and more of our ongoing program that we will be providing and programming and follow up on the software and on the course materials. Any other questions?
No, we're good.
That was thank you very much. We had some really good questions today. I think we have some interesting examples today, and we're actually seeing, based on volatility levels, if we get certain markets that are very low, that are very tame, but that could make a big breakout in one direction or another. The theme that we had of long premium today would be one worth pursuing in low volatility markets where we're looking for rising volatility and a drop. So keep the good questions coming. Please submit questions and ideas so we can add them to our frequently asked questions. And we are continuing to beef up our demo library with more and more material. We are going to be re-indexing that section so that people can more easily get to the particular videos and the particular demonstrations that will be most helpful. So we are re-indexing this section. Any feedback that we have or any requests for additional materials, we'll be happy to oblige as quickly as we are able. So keep at it. Thanks again for participating in our beta group. Have a great afternoon, and look forward to seeing you either tomorrow at our spread program or on Thursday at our granting put options program. Thank you.